One company just delivered nearly 75,000 more vehicles than Wall Street expected. Another just took a $6 billion charge off to shut down an EV production facility. Same industry, same quarter, completely opposite results. For years, investors treated electric vehicles as one giant trade. If EV sentiment improved, everything went up together. Tesla, Rivian, Ford, GM. When sentiment turned negative, everything fell together too. But this week, the data made something clear. That era is increasingly over. The EV market didn't die. Instead, it split into two. Some companies are accelerating into the next phase of the transition, while others are quietly backing away from it. One company raised more money to build more factories, yet another company is converting EV factories back into gasoline trucks. The question is no longer whether consumers want electric vehicles. The question is which companies can build what consumers want and actually make money doing it. Welcome back, everyone, to Lunch Money Investing. I'm so glad you're here. It's very lonely. You can see by the low subscribers. Please subscribe. Anyways, today we'll be digging into the state of the EV market and the bifurcation that has been taking shape over the last few quarters. Let's start with the biggest winner of the quarter, Tesla. The latest delivery numbers were honestly difficult to ignore. During the second quarter, Tesla delivered more than 480,000 vehicles. Wall Street only expected roughly 406,000 vehicles. That's a beat of nearly 74,000 vehicles. Tesla also produced roughly 452,000 vehicles during the quarter, meaning they delivered around 28,000 more cars than they built. After 2 years of investors worrying about excess inventory and slowing demand, Tesla spent the quarter reducing inventory and moving product instead. But the most interesting number wasn't just the vehicles. Tesla deployed 13.5 gigawatt hours of energy storage during the quarter, up more than 50% from the previous quarter and above analyst expectations. This is phenomenal news as energy storage carries margins north of 30%, which means Tesla increasingly looks less like a car company and more like an energy infrastructure company that simply happens to sell cars. That's a very different business than the traditional automakers. In fact, some analysts are now openly discussing a future combination between Tesla and SpaceX, not because they share a CEO, Elon Musk, but because the businesses are already deeply interconnected. SpaceX uses Tesla Megapacks for its data centers. It buys Cybertrucks for operations. Both companies collaborate on AI, chips, software, and autonomous systems. Whether a merger ever happens is almost beside the point. The fact that investors can seriously discuss it tells you how differently the market views Tesla today compared to other auto manufacturers. Tesla isn't just competing with Ford and GM anymore, it is now competing with utilities, robotic companies, AI infrastructure providers, and satellite networks. It's playing a different game altogether, but EV still makes up the majority of its operations. And if EV demand is truly scaling and robust, we'd expect to see that showing up somewhere else. And luckily, we do on the supply side for lithium. The company Albemarle, ticker symbol ALB, is one of the largest lithium providers in the world, and their Q1 2026 results back this up. Adjusted earnings per share came in at $2.95, crushing estimates of $1.31 by 125%. Net sales jumped 33% year over year to $1.4 billion, and adjusted EBITDA exploded to $664 million, up from $267 million a year ago. Net income surged $319 million, a massive turnaround from the razor-thin $41 million they posted in the same quarter just a year ago. Now, this is not a company riding a dying trend. It's a company riding a real recovery in physical lithium demand, which lines up exactly with what we're seeing out of Tesla and Rivian. This is not an Albemarle video. However, it is important to note that they report Q2 earnings in August. This is worth watching because if that story continues, it shows that demand for lithium and thus EVs remains robust. Now, turning to Rivian, at first glance, you'd think the company had a terrible quarter. The stock fell more than 18% in a single session just the other day, one of its worst days in years. But the reason investors sold has almost nothing to do with the underlying business itself. Instead, Rivian announced a 75 million share offering to help raise roughly $1.5 billion. Existing shareholders rightfully worried about dilution. Underneath that, however, the quarter was actually exceptional. Revenue beat expectations, deliveries beat the company's own guidance, Cash balances increased. Management raised its full-year delivery targets, and Rivian delivered more than 12,000 vehicles, despite guiding for 9 to 11,000. Rivian didn't raise money because demand collapsed and they're cash strapped. It raised money because expansion requires capital to support its ongoing manufacturing activities and build out in Georgia and to meet the Department of Energy loan requirements. Now, that's a very different problem to have. Rivian isn't acting like a company struggling to survive. It's acting like a company preparing to scale production, and that takes time and money. Then there's Ford and GM, the other side of the split. Ford EV sales fell sharply during its most recent quarter. Deliveries of the F-150 Lightning and Mustang Mach-E disappointed, and the EV segment overall posted an EBIT loss of nearly $800 million in Q1 alone. Now, this is down from $850 million loss a year ago, but still significant amount of money to lose, especially in one quarter. Management is now pivoting towards a cheaper universal EV platform to bring costs down. Even with that pivot, they expect full year 2026 EV segment losses of roughly $4 to $4.5 billion. Meanwhile, Ford is investing heavily in energy storage, software subscriptions, and manufacturing quality. They're not abandoning EVs, but they are clearly admitting the version of strategy that they first brought is not working. GM's response has been much more dramatic. Earlier this year, GM took a $6 billion charge off tied to reducing EV production capacity. Factories originally built for EVs are being shifted back to gasoline trucks and SUVs. This realignment builds on the $7.6 billion EV losses and write-downs recorded through 2025. In terms of sales activity, GM's EV sales fell roughly 37% year over year. Volume drivers tanked significantly. The Chevy Equinox EV plummeted 61.8% to 6,600 units, and the Chevy Blazer EV plunged 68% to just 2,100 units. Despite the setback, GM remains the number 2 EV seller in the US, capturing almost 14% of the market share. The overall EV landscape has diverged into two camps: growth and holding on. Tesla is scaling, Rivian is expanding, Ford is regrouping, while GM is retreating. The EV market didn't move in one direction over this last year, it's moved into 4 different directions. And this is all happening against a macro backdrop that remains surprisingly resilient, though uncertain. The latest ISM Services PMI came in at 54, in line with economists' expectations. Anything above 50 signals expansion, and this marks the 24th consecutive month of growth in the services economy. Now, digging a bit into the details, we saw business activity slowed slightly, new orders softened a bit, but employment unexpectedly rebounded, back above 50 after months in contraction. This is a sign that businesses may be getting more comfortable hiring again. The inflation picture was a bit mixed. Prices paid fell from 71.3 to 67.7, still elevated but no longer accelerating, at least not yet. If this trend continues, we'd expect that moderation in service prices to eventually show up in CPI and PCE data. However, the recent restart of conflict between Iran and the US throws a wrench into all of this. There were overnight attacks on Iranian targets, and at a NATO summit on July 8th, Trump mentioned that the recently signed MOU is no longer valid. We don't know what that means, and we know Trump could change his mind any minute. He can be changing his mind before this video is over, so we'll just have to wait and see. That said, the inflation patterns painted by the data so far are not imaginary. The Fed's own June meeting minutes, released just this week, tell us almost the same story. Committee members described inflation as elevated and still running above their 2% target. Nothing new there, but noted that the risk to employment has moderated, while risk to inflation stayed tilted to the upside. Again, nothing new. That's almost a word-for-word match for what we just saw in the ISM report. Prices paid still elevated, but employment quietly firming up. The Fed held rates steady at its latest meeting, and part of the reasoning was exactly this kind of data: solid growth, stable labor market, and inflation that isn't accelerating, but also isn't going away. I'm going to do a full breakdown of these meeting minutes in a later video, including some of the more interesting AI investment and Middle East conflict commentary buried somewhere in there. This video is simply just a quick overview of the headlines of what just came out. But check in later this week and you'll see more detail in a different video. Anyways, the economy feels very different than the one investors feared 12 months ago. Growth is positive, Consumers are still spending money. Employment is relatively healthy. The consumer isn't disappearing yet. They're becoming selective. Consumers aren't rejecting electric vehicles. They're rejecting electric vehicles that don't provide enough value. Tesla has figured that out. Rivian appears to be figuring it out. Ford is desperately trying, and GM is willing to wait and see what happens. Again, for years, investors treated EVs as one monolithic trade. This quarter may have marked the end of that era. The EV market is not dying, it's not stalling, and it's not failing. It's simply splitting into two. And that may end up being one of the most important investing stories of 2026 that will impact investor returns and portfolios for years to come. But I'm curious, what do you think? Will Tesla keep becoming something bigger than an automaker? Can Rivian give Tesla a real run for its money? Or do Ford and GM eventually find their footing and become real players in the space? Let me know what you think in the comments below. I'd love to hear your take on this. Also, smash that like button and consider subscribing. I'm watching markets daily, reading earning reports, and sharing what I find here every week. Thanks for watching, and as always, protect your lunch money. I'll see you on the next one.